Hey everybody, good morning, happy Monday. Welcome to the morning show here on Stock Market TV. I am Spencer Israel, joined by Steve Strazza. JC Parets is not here today. He had a really bad Saturday with the football and the kneeling and the fumbling and the touchdown. So he is in a deep hole of shame right now. He'll come back to us tomorrow, I suspect, after he recovers from his Miami football-induced hangover. But the show must go on. Mark Newton is our guest today. He'll be on at 8:50. We'll have Kimmy Sokoloff on after that and Sean McLaughlin after that. We got a lot to discuss, a lot of macro-y things happening over the weekend. We got the charts. I see you here in the chat. Good morning, everyone. Good morning, everyone. Let's go. It's time. Where's my intro? What up, Steve?
You just did JC dirty like that, huh? With him not even here to defend himself?
Well, what was I going to do? Not mention the fact that, I mean, come on, that's obviously why he's not here right this morning, right?
Oh, all right. Good. I like it. No comment for me. I didn't. So I was a little background, a little context. I was supposed to go meet him at the Miami Giants game yesterday, but girlfriend had food poisoning or something Saturday night. We didn't end up going. I'm kind of glad because I didn't want to watch the Giants anyway. I don't want to spend any money on the Giants this year.
Yeah, no.
Yeah, but he's still in Miami.
What's up with your internet today? You having a little bit of a slow day on the bandwidth front?
Is it lagging?
Yeah, you're a little laggy today.
Let me close some things. I've been working hard over it.
Maybe it's just a Monday morning lag. Maybe close out some stuff.
It's the 800 open window lag.
Dude, you gotta. Oh my goodness, I feel like I'm talking to my parents here. You gotta close things out if you're not using them.
But I come back to them, so it's an ongoing issue for me, right? I'll be like, I'll read that later. Leave it up. A week later.
You gotta, especially your browser. Like, I don't know what you use. I use Chrome, and it just suck. It's a succubus on your short-term memory. Gotta close that stuff out, man. All right, should we talk markets here?
All right,
let's. All right, stay in the markets. Let's go. All right, what do you got?
We've talked about international stocks a little bit last week, right? How breadth has really deteriorated overseas. Mm-hmm. But we never really had a chance to really rip through these charts. So I brought along a handful today. We're going to rip right through them and just paint this picture of what's really going on there, right? So throw up my first chart. Germany, this is the biggest one. You know, from a developed market standpoint, probably more important than anybody. Is this a top? I don't know. Sure looks like a top. Do they come in here and repair it? And this is just some sweet bull hook and the next leg is on? Maybe. That could very much be, right? We've talked so much about failed tops over the past few months and just past few days and weeks, right? Last week, failed tops. Is this a failed top in the NASDAQ tech? Is this a failed top in Germany? We should know soon. But the answer to that question is going to be a big one because I have a feeling if we keep going through these charts, they're all going to be either failed tops or real tops, right? You're not going to see, a bunch of them going in different directions, Germany hooking higher while something else, fails and rolls over here. So the way that these really resolve in the coming days and weeks is going to be huge. Let's run through them. What's next? France, same thing. Is it a top? Did we dig in here and make a save? I don't know. Look at that 200-day moving average. It was curling higher, indicating a new uptrend was underway since late last year. Now we're kind of back into a sideways regime. What's next? UK. It's one of the stronger countries in developed Europe. Big old top, right? What's going to happen here? Do we hold these pivot lows? Do we rebound, bounce higher? I don't know. We got to monitor this. Next. Sweden. Same thing. Spencer, do you get it? Get what I'm trying to do here?
I'm sensing a pattern.
Trend was higher. Then we got stuck sideways. Momentum just died off in the first and second quarter for all of these international country ETFs. So now we have this big kind of holding pattern. Is it a continuation pattern or a distribution pattern? We don't know yet. Next. Poland. This was one of the strongest groups. I was having conversations about how awesome Poland was with a friend of ours at Future Proof. This is what the best ones look like, right? Is this going to dig in and hold? Let's see. Next. Japan's a big one too, right? I say Germany's the most important. Japan can have an argument to make there. Is this big base going to come undone, right? Fall back into the box down there below 58, those pivot highs. You don't want to see that. Again, one of the strongest countries.
But does every major international market? No, they don't all look like this. There are some that are holding up better. I thought. I mean,
like what?
Not Brazil. I don't know.
Let's
I thought Brazil,
the better ones. Like throw up Argentina. Let's look at some of the better ones then. Argentina.
Funnily enough, Brazil looks the same, but
where's ARGT?
I think we have it. There we go. Yeah. Okay.
That's one of the best looking ones. Imagine if that's back in the box.
Yeah.
Show Greece. Greece is another one. Greece has been really strong. So we're at like kind of an inflection point here for international equities, right? You don't want to see the strongest ones that look like this, fail and roll over, get back into these boxes here. Not good at all. And then let's look at some of the weakest ones. Do we have Thailand?
Do we have Thailand? Good question. Here we go.
Oh,
gosh.
I remember being out in Thailand in July and telling people out there at the CMT, I'm sorry, I wish I had nicer things to say about the local equity markets here. Now we're at new lows. So the good ones are failing, undoing bullish patterns, these bearish to bullish reversals that had completed, maybe coming undone in the best ones. And then the worst ones just really breaking down and looking terrible. So like the answer to your question would really be no. There aren't ones that really look much better.
It's probably worth noting that geopolitical events like we got over the weekend are definitely not good for markets like these, right? So
really,
what? I mean,
these tops have been printing since the second quarter. This has nothing to do with Gaza.
Sure, but that's not going to help the situation, is my point, right?
Let's talk about Caleb Franzen's tweet. Did you see that? I thought that was excellent. You want to talk about geopolitical things? Fine.
Yeah. I mean, we should. I'll bring it up right now.
Yeah. So I think what Caleb did here was great. He basically threw his hands up in the air and said, I don't know, right? I can do certain things as an investor. There are certain things I can control. And then there's this geopolitical crap that's going to go on and is frankly always going on. More or less he's saying ignoring it. What he did do, which I loved, and I want to read, is he made a list of the things he won't do because of geopolitical developments.
Yeah.
Okay, so here we go. I will not buy any gold or precious metals. I will not buy guns, ammo, or canned foods. I will not sell a meaningful. Listen to this one. I will not sell a meaningful portion of any stocks as a direct result of these developments. I will not diversify my U.S. dollars into other currencies. I don't know. I think you would be diversifying other currencies into U.S. dollars, but he said he won't diversify his U.S. dollars in other currencies. I will not short the market as a direct result of these developments. Perhaps the only adjustment is to lengthen the DCA schedules. In other words, he's saying, I'm just looking to, continue to scale into these long-term investments more, maybe, right?
I agree with you. I think this is a fantastic tweet. I agree with everything he said.
Yep.
That's not.
I think the exercise, even more so, right, than the actual contents of what he's saying here, it's the simple exercise of telling yourself, programming yourself, okay, if a war breaks out, if these, bearish geopolitical developments start taking place more and more and more, I won't do X, Y, Z. I won't change this. I thought that was just so fantastic. Maybe everybody should make a list, of the things that they won't do. In other words, don't go throwing out your Apple stocks and your Microsoft stocks and your Nvidia because of what's happening in Israel. Absolutely crazy.
I obviously it should go without saying that we hope everyone who I don't know if we even have any viewers over there, but we hope you stay safe. We hope everyone stays safe. I've got some people over there, and it's freaking horrible what's happening. That being said, yeah, I agree with all that stuff, but there are always short-term. That's the key word. Short-term implications. You're seeing it this morning, right?
Boy.
You're seeing it. What?
Oops. You mean like on gas prices? Sorry.
Dude, what the hell? What was that?
I just threw the newspaper down onto the stream deck.
Dude, come. Oh my God.
Sorry.
I'm talking about oil. I'm talking about defense stocks. There are a bunch of companies out there that are based in Israel. There is already and going to be more movement of volatility today as a result of the violence over the weekend. But yes, I agree with Caleb's tweet. By and large, unless you're making super short term stuff, like Kimmy is doing, then just stick to the plan. There's always going to be some event that will threaten to throw you off course. We had a war start last year too, right? Wait, was that last year? Was it? Yeah, it was last year. Gosh, I can't even keep track anymore. So
I like this one from the chat. But do you buy oil?
Well, there's actually multiple oil headlines today. One of which came from OPEC.
Can I read you the oil headline from yesterday, though?
Yeah, sure.
Why oil prices soared and why they are sinking now. All these reasons why oil prices are sinking. And then a war breaks out. Whatever we're talking about.
That's the thing about oil, right? Is it can change like that.
Crude oil is having its best day since April right now. So again, don't overthink this stuff, right? Do you want to be long oil right now because of geopolitical factors? No. You want to be long oil because of the price action we're seeing in energy assets and oil, right? And one thing that we do know is that the reactions to headlines and news and geopolitical events tend to occur in the direction of the underlying trend. So I wouldn't say buy oil because of this. I think you can be long oil for other reasons, and maybe this acts as a catalyst to get you to your objective, right? Your price target. Great, but I don't think it should be the reason why you're long oil.
OPEC did raise their long-term oil demand outlook over the weekend. They said by the year 2045, they expect oil demand to reach 116 million barrels per day, up from their prior estimate of 110 million barrels per day. So there is that, but oil is so okay. The question was, do you buy oil today? Well, what are we talking about here? We're talking about a trade. We're talking about longer term swing trade investment. Everything to Steve's point. If you're going to buy oil for a long term investment, it shouldn't be because of what happened over the weekend, right? That's not a reason to invest in something. If you want to buy it for a trade, yeah, sure. I mean, yeah, there's always a trade to be made, right? Oil's having its best day since April. You said, okay, that's going to create some opportunity today, no doubt. But depends why. It's all about your time horizon. It's all about.
That's right, because these energy assets, as good as they look over longer time frames, they're still stuck in these holding patterns, right? And crude oil, if you look at it today, it's just bouncing off a very well-defined level at its pivot highs.
So we do have crude up, not quite, but almost 4% this morning, about 3.85%, and it is obviously the story of the morning in the markets and that's definitely the biggest reaction we're seeing in the markets from the violence over the weekend. That and defense stocks, they are all trading higher as you would expect, right? Lockheed, Raytheon, Northrop Grumman, General Dynamics, L3, those are your biggest names. They're all trading higher this morning. They're all leading the way as far as the U.S. stock market is concerned. and that's to be expected. And this is what happened in February of last year too, when Russia invaded Ukraine, and this is what happens every time there's increase in violence is defense stocks, right? So, but again, keep an eye on the long term trend. If you want to own this thing for the longer term, one war is not the reason, right?
These aerospace and defense stocks will be talked about. They'll be all
For
over
sure.
the CNBCs today,
For
right?
sure.
All the talk. But again, if you went back, we've tested this time and again over the years. If you go back and test war periods and see what these A&D stocks do, it's a crapshoot, right? They're not the best performers. It's usually like semiconductors or whatever's already been working in that bull cycle. So
nowadays,
it's a headline, but it's not an investing strategy.
It's not. Yeah. Headlines are not an invest. That's a good way of putting it. Headlines are not an investing strategy.
Do you want to talk about just how evil Weight Watchers is and what a terrible person Oprah Winfrey is?
Man, that's a hard pivot. I mean, we got 3 minutes to mark. I don't know if we have enough time to cover Weight Watchers in 3 minutes.
Yeah, let's do it. I mean, did you read what I sent over?
I read it over the weekend. Yeah. So we can save it for the save it for after mark. But what we can cover right now is going through just the list of what's going on this morning and headlines. Disney, you and I both saw this independently of each other as well. Nelson Peltz is just trying to get on the board or trying to get his people on the board there. So you're going to get another proxy fight at Disney. That's why that's trending up this morning.
Should we be surprised? Do you know how these things happen?
Well, he did this. He tried this once before, and then he settled real fast. So I'm not quite sure why he's.
So why is he back?
Yeah, why is he back?
Look at the stock chart. That's why.
Well, okay. Yes.
When you cannot get off the ground, your stock just keeps falling. Wide open door for activists. It makes their job of sneaking in and getting board seats much easier. Makes their demands heard. They've become such an easy target for this.
They have been.
And that's it. That stock price has to stop falling. Things are bad and getting worse over at Disney. They should be very happy to have somebody like Peltz on board. And you're right. They struck some deal like right away. I think it was as soon as Iger came back in like last year.
That's right. Because Peltz was circling with the other guy, Chapek, and then Iger came back, and then he smoothed everything over.
For a little bit, it seems. But it comes down to the stock price, right? Say that happened last year and then Disney recovered and rebounded and the stock was doing better, right? Peltz wouldn't be back in here because the stock price just won't stop falling. So if you're a Disney investor, I think you should be glad that he's in there trying to mix things up.
Wait, question from Mike in the chat. I understand why coal would be up in sympathy to oil, but uranium is down? ?
It's not. Stop. It's not about Gaza and Israel or Ukraine. It's just not about that. Uranium stocks have been up a ton, and they gave some back. Right? We talked about the standard corrected.
I think one more do you want, honestly?
Don't overthink. Now you're going, okay, so it's one thing is crude oil moving based on these geopolitical headlines? For sure. But you don't want to go to the fifth derivative and be like, what about solar stocks? Why isn't coal or uranium up? No, it's not. This is probably not moving those markets.
At least not yet.
I mean,
all right.
I think this is a crazy thing that investors do, where a sexy headline comes out and it's interesting. It's like, what's the trade? The trade is nothing. The trade is to ignore that and keep doing what you were doing. That's the trade here. Don't go buy Lockheed Martin and oil right now here today.
In my experience, the reactions on events like the one that we just had or similar, they're almost always, the instant reaction is almost always an overreaction in some way, shape, or form, right? So that's just what I've observed over the years. So sure, all the defense stocks are going to open higher, oil's going to trade higher today, but that's by no means an indication that these things have to go up all week, right? Because it's not that simple.
And here's the other thing. Last one from the chat. I missed Uroy Friday. Man, gutted. Okay. So Uroy, this is a uranium royalty company, up 10% Friday. You didn't miss anything. If you zoom out on these uranium charts, these are massive bases. These are structural reversals, right? And the path of least resistance is just starting higher. So if you are walking in with the attitude to these markets that, oh, I missed something based on one day's trading action, then this bull market isn't for you, right? This is for the patient long-term investor. This probably lasts a very long time. You want to pick your spots, get in, manage your risk, scale into these things, and then hold it and kind of wait. This isn't for the day trader or the swing trader. Like I've been accumulating coal and uranium stocks for a year and a half now, right? And I'm going to keep doing it because I think this bull market lasts for years. But it's not one day, 1 week, 1 month. You're doing it wrong.
Yeah. All right. We got our guest here, Mark Newton, head of technical strategy at Fundstrat. Let's bring him on. He's got some charts as well.
Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Mark Newton.
Hey guys, how are you?
What's up, Mark?
Steve, good to see you guys.
Is
JC sleeping in today, or what's happening?
It's football shame. I'm afraid.
Spencer's just wrecking him today while he's not here. Oh man, you better hope he's not watching. Yeah, JC's in Miami.
Sounds good. Well, good morning to everybody, and hello. Thanks for having me again.
Mark, you asked a question in your most recent post on Friday, right? Are the lows in or not? Let's review. So I've got a couple of those charts here. Why don't you walk us through that how you would answer that question?
I like this.
Sounds good. So, all right, I can go on my side. Are you going to load charts on your side?
I got it. Yep. I got your charts right here.
Throw them up.
All right. Well, look, this is just an hourly chart. It does show what could be the presence of a 5-wave decline since early September. So, part of my methodology is obviously Elliott. I look at traditional structure. I look at sentiment, DeMark cycles, obviously sector rotation. What I think is fascinating about this whole recent, what you want to call, 8% decline from July, is that technology has held up remarkably well and much, much better than what anybody would have thought. And so, getting up above 43.36, which obviously was these prior swing highs from September, as well as, recent August lows, would be quite important and would suggest to me that we have in fact bottomed, and honestly that we should push back and challenge 4,600. So there's a lot of reasons for that, and I can go through them one by one, but I think a lot of this has to do with just traditional seasonality. August, September were both abysmal.
You've been saying that, yeah.
October is the notorious bear killer month. Finally, we have evidence of sentiment having gotten quite pessimistic based on a number of different polls. Not only just sentiment, but breadth has reached levels that historically have coincided with lows. And so you look at the percentage of stocks above their 20 and 50-day moving averages in the S&P that have now reached single digits.
Washed out.
That's a rarity. I mean, it doesn't happen that often in any given year. So we've reached actually the lowest level of the entire year with regards to breadth, specifically based on how you measure it that way. So I think technology is acting well. You have a number of different areas that are reaching support, meaning regional banks, transport stocks, just to name a couple. And I think that if all these other areas, even small caps, are down near levels that are really, really important when you look at IWM. And so I look at relative charts. I look at DeMark signals on some of these. How does small cap look versus the S&P? Bottom line, I don't think it's going to be tech that falls to join the others. I think it's all these other sectors that are going to bottom and start to rally at a time when many probably least expect it, specifically given, geopolitical events heating up.
So you're saying there's got to be a catch-up trade from some of these lagging groups, whether it's smalls or financials, if the market is going to find a bottom here?
I think that is going to happen to make it broad-based. I don't think it has to happen. We've obviously seen markets hold up extraordinarily well, but that's largely been technology, and everything else has pulled back. So it's not dissimilar from 2021 in some respects, where all these other groups start to falter and tech is hanging in there. And so, the broader indices, you look at weekly charts of, can I share a couple things real quick? And I'll show you.
Yeah. If you hit that little plus sign or that little screen
I'll
share
share
thing.
you. Let me see.
Mark, what do you make of the whole tech relative strength, though? A lot of people are trying to build like some fancy stories and narratives around this. Some of them sound better than others. With rates ripping, I think you allude to the fact that maybe you wouldn't expect that kind of strength. Do you have any idea or story for why this is happening? Why tech is leading?
Well, look, I don't pretend to be somebody that always has a narrative of why something is happening. I would just mention that, rates are in the process of trying to peak out. I think that's important. And, potentially they're sniffing out a peak in interest rates. They know that the Fed is likely done. If not done already, then they will be done as of next month. So I think that, in general, the Fed starting to pivot, there's going to be a flow back to growth, and there's going to be a flow back to technology, which obviously benefits as that happens.
Yeah.
So I'll pull up a few things. I'll run through a couple things real quick, and you guys just.
What do we got here? NASDAQ?
Stop.
Yeah, that was a NASDAQ. It's just another in a continuing series of examples of how remarkable tech is, and you wonder why everyone wants to be overweight tech, whether they're on the indexes or not. It's because every dip has been rewarded if you've bought it, right? So
it's funny because like Q4 and Q1, we had this big interest in some rotation, value, and cyclicals, and commodities.
Yeah, it's always short-lived.
and there were a lot of people, it was like, don't give up on tech yet. I mean, it's so hard to bet against these, especially these mega tech.
I know.
So I'll show you a couple things that sort of helps you to understand my way of thinking. And initially, S&P is down to what I think is a real make or break. I mean, if we get down under 4160, then I'd have to say, okay, we're going to have a larger correction. I don't think that happens because of fear, because of seasonality, and specifically because of technology. So, I don't use the 200-day moving average, but it is right below where we are. You have prior peaks from February, and you look at a weekly basis, you can say, well, what correction? It's been resilient since this time last year. And here's technology. So equal weighted tech versus equal weighted S&P. I mean, this is a phenomenal chart. This is tech, right? This is
breakout.
This is stripping out all the FANG and everything else. This is equal weighted technology. So it's not just, large cap tech that everybody argues has made the majority of the move. It's software. It's semiconductors.
Right.
There's a lot of stocks that are working.
So equal weight tech versus equal weight S&P ratio. I've been looking at it too. Let's throw this up. It ripped off the COVID lows really since like 2019. Been ripping, and then what a lot of people probably don't realize, if you're just paying attention to the news, you're hearing all about this tech leadership, tech outperformance. Tech has performed in line on an equal weight basis for 3 years now, straight sideways.
Yeah.
So that to me is a nice consolidation, nice digestion of that outperformance from 2019, 2020.
Yeah.
And maybe this breaks out. That means move like higher. Get used to.
So that's a larger chart that really is also very key. So when we get confirmation of the 10-year getting down under 336, then I think that happens into next year. I think tech and industrials are the groups to favor, and energy is slowly but surely. It's going to be a tougher trade over the next 6 months, in my view. Energy is due to consolidate, but I think it's still working for the time being. We had a sharp pullback last week, and obviously we're rallying pretty sharply today.
If you look at something like XLE or even the equal weight large cap index, it keeps running up against those pivot highs and failing. Like that range has to resolve. Then let's talk about energy all day and some, leadership from energy. Get the breakout, right?
Don't disagree. Easy money has been made for this year. I think that on a consolidation, if crude goes to the mid 70s, low 80s, I would love to buy energy. And I think that a new bull market in energy started in March of 2020, 3 years ago. So it just you have to be aware of the sector rotation, and you've had a small bit of evidence that maybe energy might not be the place to be for Q4.
Yep.
So I'd rather buy tech, honestly, and I'd rather buy industrials.
Yeah, be patient with energy. So what could derail the energy bull thesis? Like, do you overthink interest rates or the bond market as it pertains to energy? Do they need rates to keep rising?
Well, to a certain extent, they're all linked. I mean, yields in the dollar have been pretty negatively correlated with the stock market for at least the last year, right? I mean, the dollar bottomed in July right as stocks peaked, and vice versa for yields. If the 10-year goes to 5%, or let's say it goes to 550, stocks are not going to like that. They're going to sniff out a softening in demand, specifically if China doesn't come back with a vengeance. And so, yeah, all of that can be potentially a negative for demand, which is what really crude declined on last week. They said that EIA report came out, said that demand for this time of year had declined to 25-year lows. So that's not a big positive for the bulls. So yeah, we need to see some evidence that, and I think the demand is there. I think when rates roll over, the consumer is going to be helped in a big way. The housing market specifically has helped consumers. Nobody's selling their 3% mortgages to move into an 8% mortgage. So, it's a strange labor market, but, there shouldn't be any recession right away. The market's still holding up, and the consumer, I think, will be fine, at least for the next year and a half.
Yeah, it seemed very resilient. All the GDP numbers, the GDP forecasts keep coming in pretty positive.
Right.
And it's surprising a lot of people, too.
Yep.
Do you think that's the same overseas? Like internationally, you mentioned breadth quickly in the U.S. being kind of washed out, percentage of stocks above XY moving averages.
Yep.
We're kind of seeing the same when we look at our universe of international ETFs as well. Really washed out breadth.
Yeah, that's going to probably depend on the U.S. dollar to roll over to really be bullish on EM or to be bullish. I mean, it's tough to be bullish on Europe. In my view, I just think look, the U.S. is the best house in a bad neighborhood, as they say. It's much better than China. You want to overweight U.S. versus Europe, and yeah, there are areas that are interesting to me. Of course, India and Japan, and but yeah, by and large, I don't mind being long. Anything with regards to U.S. I think that's the place to be.
Mark.
Yeah, go ahead, Spencer.
What do you say to people or clients that come in this morning after the events of the weekend and they're all riled up and they want to make some changes because, war is bad or this and that, the other thing?
Good question.
Being a card-carrying member of the CMT Association for 30 years, I say you ignore the news and you see how prices respond to it. And the pullback that we're seeing this morning in futures is sort of a drop in the bucket. This isn't really a big surprise or a big shock. Wars tend to be resolved quickly in markets. They don't tend to be long-lasting unless the market is completely caught off guard. Obviously, I feel for the Israeli people. I heard there were 1,000 people that perished. And that's really sad. And, you hope that the Middle East conflict gets resolved quickly, as well as Russia-Ukraine. But I don't look at the stock market through that lens that, I'm more of a glass full person with regards to any sort of external event that I think might shock the market. I just think it's really, really difficult to make decisions based on that, specifically at a time when we're already seeing quite a bit of fear when you look at almost every poll out there. So people are already negative. For somebody to come in now and say they want to get out of stocks because of, what's happening.
Then maybe the stock market is just not for you. I mean,
those are some real words of wisdom. I was trying to say something similar before you came on, Mark, but boy, that was put a lot more eloquently.
I think if you're involved in the retail sector, anything consumer related has been abysmal and is really not my top area. So it depends on what you own. And if you're involved in stocks if you're involved in a ton of regional banks or in retail stocks, or if you're a big utility investor or involved in the REITs, I mean, obviously there are areas that are not working very well. And so those aren't, there's a reason to say, well, maybe you want to cut your losses in some areas and reposition, or even consider things like gold and silver. I think make a lot of sense at a time when real rates should be peaking and start to pull back. I mean, the metals are closing in on a time where it's their time to shine.
Really? I got to see it. Because these things, I've heard that a million times, Mark. I got to see it. these precious metals. Is real rates the biggest thing from an intermarket standpoint for PMs?
With regards to what? With regards to the metals or just in general?
Precious metals.
Yeah, I think that's true. I think you see pretty clear, um, correlation between the treasuries and the metals. I mean, over the last few years, every time that rates have bottomed and started up, it's been a very difficult time for precious metals, and particularly during this time with real rates spiking up to new highs. I mean, the charts on real rates are pretty compelling. So I'm honestly, fighting the trend specifically over the next 2 weeks and thinking that we're in a bottoming process for other reasons. But that is one thing that is key. I look at a lot of positioning data, sentiment, seasonality. October tends to be a very good month for the metals, particularly when everybody's bearish and some of the commercials are loading up and buying, and rates are churning near the highs and have stopped going up. I think that makes for a really interesting trade.
So I have something I've actually been wanting to ask you about since last week. You're a big DeMark guy, and I was dipping my toes in reading some stuff last week. I think Tom DeMark came out, something about we were on like a sell signal 13 that failed, and that turns into a buy signal. Did I explain this correctly? Is that in the major averages? Did you see this? Hear about this?
He looks at a million different markets, and he also has a lot of different time frames, and so that makes it really challenging unless you really, really know exactly what he's speaking about. So I tend to think that we did what was called, we got what, TD buy setups. I won't get into the methodology, but that happened a couple of weeks ago, and then we promptly took out the lows. My own view on DeMark stuff is that it probably, I wouldn't use that as one of the top reasons as to why I think stocks are bottoming here, but I do utilize that. I utilize DeMark quite a bit in a lot of my work.
All right, you get one sector for Q4. Is it tech? What would it be? And if it's not tech, give me a second one. Or if it is tech, give us a back.
Yeah, I like technology. I mean, the chart that I showed on equal-weighted tech sort of spells it out, and I think that happens as if I could list two, I'd say industrials and tech. I think those are my top two.
Nice.
Still tough to favor healthcare. Look, it's the best of the defensives, but it just hasn't worked that well. If rates roll over, that's going to help the med tech spot, and biotech has been under a lot of pressure. But I don't really want to own the defensives if risk on comes back to life, and I don't really care about financials. I think the regional banks really have a lot of work to do, and the financial space in general is just under pressure relatively on an absolute basis. So you got to pick your spots there too. So discretionary, I don't know what to think about that group. It's still trending down on an intermediate term basis, and so we had a great rally last year, but it just is not attractive. So for me, tech and industrials.
And I'm with you. That was all great. I think there's another shoe to drop in financials with the regional banks.
Mark, I don't think the defensives want to own the defensives right now.
Well, the thing about
I think they can bounce. They've gotten really stretched, but I wouldn't pick that group as one to own at a time when I think stocks are going to be bottoming. Either potentially have bottomed last week or are going to bottom this week. So I honestly am pretty optimistic about stocks for October. I do think November has a hiccup, but I don't think we're going to move down under recent lows what we've seen.
And here's the problem with the defensive stocks, Mark. Correct me if I'm wrong, but I think this is what you're saying. The defensive stocks couldn't even outperform while we've been correcting all summer. Barely outperform.
Yeah, some of that. Well, half the group is probably very closely tied to interest rates. So you have the utilities and REITs and things that are interest rate sensitive, and they obviously don't do well, but they really, really have been taken out to the woodshed in the last few weeks in a way that staples have moved down to almost new yearly lows. I mean, it's extraordinary. You look at consumer staples on an equal-weighted or just a cap-weighted basis, and so these are ones you got to be selected. Like, I don't mind buying some Monster worldwide, but I don't want to own most of the staples outside of just for a trade.
Right.
Isn't Monster the highest beta staple there is? Something like that. I don't know.
Good one.
Maybe I'm making that up. All right.
I'll leave beta to you guys.
Yeah. All right. Mark Newton, head of technical strategy at Fundstrat. Mark, thanks for coming on today.
Thanks, guys. Have a great week.
All right.
Take care.
Always a pleasure.
Whoops. Sorry, Steve.
Taking me out.
Sorry about that.
He's awesome. Another great.
All right, Mark is great, very eloquent, very well spoken about markets. You can tell he has a lot of experience in answering questions like ours from
Did you hear what he
clients
said,
or otherwise.
Spencer? He's been a charter holder for like 30 years. I mean, this guy been around. Talk about an experienced technician. Oh.
Yeah. Mark knows what's what. If you want to follow him on Twitter, his link is in the description. Check it out. All right. We'll have Kimmy on in a couple of minutes, but before that, do you want to talk about Weight Watchers? I think you do.
I do.
Yeah.
I do.
All right. So here's this article from over the weekend, right? Let's bring it up on the screen if I can. So yes, it's basically an article about how Weight Watchers is having a come to Jesus moment with itself.
Is it? Is that what this is? And explain what that means.
That's how I interpreted it.
Come to Jesus. What?
Yeah, they're having an identity crisis, right?
Okay.
Isn't that what that phrase means?
They're following the money, in my opinion. But yeah, I guess.
Well, all right. There's that too.
Shift. All right.
Yeah, a shift away from willpower, and it's your fault that you're overweight. To it's not. It's okay to take drugs to lose weight. Prescription drugs, I'm referring to, not all drugs. And it's not your fault that you're overweight. Is sort of the new messaging coming from them, according to this pretty in-depth article about it. But is that how you interpret it? Because that's
It seems to me it's a giant pivot from a company that we all knew as one thing for a long time, right? And now they're like going on this apology tour to the world. We're sorry for telling you this about dieting and weight loss. It's not your fault. There's no shame in taking drugs. But here's where it gets really interesting, right? Everybody, I think, knows the history and the point system that they used to do. And I think a lot of it didn't work. So a lot of the articles about that, the CEO and Oprah are literally going around telling people we're sorry. We got it wrong. But here's why. Here's really why. The promise that a doctor's prescription can eliminate extra weight for good has touched off a seismic moment in global health and has compelled Weight Watchers to undergo its most radical change yet. Here's why this is really happening. So that it could prescribe weight loss drugs.
That's it.
Ozempic.
That's it.
So that they can prescribe weight loss drugs. The company paid over $100 million to acquire a telehealth company called Sequence. They're selling these things.
Yep. Oh wait, I didn't know until reading this article that what's the thing about I guess I never really understood what their product was. Most members subscribe to a digital plan for $20 a month that includes access to an app with recipes, plans, chat with coaches, blah blah blah. I didn't ever realize
and prescription access.
Well, yeah, now apparently. So
I don't know.
Anyway,
the company. I think this is a good one. The company that defined dieting is sorry it told us to have more willpower. Now there's no shame in being overweight or in taking new weight loss drugs. It's just marketing. Yeah. And Oprah's a scumbag for this. I mean, really terrible. I'm sorry. But she's been doing this for years. Anything that they want, she's a major shareholder. She's making so much money off of this shit. And it makes me sick. So, very sad. It's really sad what's going on. I know I've been vocal about it, but I'm going to continue to be. This whole weight loss drug thing, this Ozempic stuff, whenever you see so many companies, the whole industry is doing backflips trying to get behind this thing, it's going to blow up. It's not going to last. This is blockchain. This is Long Island iced tea turning into blockchain.
I don't know if it's – there have been other – not that I can think of them right now, but there have been other drug fads.
Yeah, look up Fen-Phen.
What is that?
Like in the 90s or 2000s. We've been through this.
Fen-Phen?
Yeah, this happened before.
Oh, Fen-Phen diet pill. Oh.
Mm-hmm. This is just
know that.
the new Fen-Phen. You'll hear about how terrible it is 5 years from now. Oh,
maybe. I'm not going to take it. So somebody else be the guinea pig, please, and report back to us in a couple of years.
I'm really bearish, and I do think Novo and maybe Lilly too are now uninvestable because of this.
Well, it's
trade fine, but long term, I don't want anything to do with those companies.
It's funny you say that because we talk all the time about how the market is forward looking. I mean, like there and Novo and Eli Lilly, like there's no pot. Well, Eli's come off a little bit already, but like there's no way that they can live up to these expectations, right? I mean, if you look at the runs they've had in the last couple of years, it just like it would seem to be they're pricing in years and years of growth already into these things. It's crazy how strong they've been.
Right. So this is it. They're never going to give that money back. That's theirs now, right? And like you're saying, they've been making tons of money off of this already. But now the stocks are valued in a way that they're counting on these cash flows to continue into the future. And I think that is the stock has been discounted or valued in a dangerous way because of that. Because if, God forbid, those things dry up and those revenue streams disappear, these stocks are going to get slaughtered. So now that's what you're buying, right? A lot of times when you buy these growth stocks or these stories, you're buying that new revenue stream. You're buying that exciting story. When that thing ends and dies off, the whole bullish thesis falls apart. So now you have to know when you're in Lilly or Novo, you're investing in these weight loss drugs, being successful and staying around.
You are buying under the assumption that this gravy train is going to keep increasing, which we don't know.
And this is a good point too. Like Frederick, Ozempic has been around for a long. I know it's been around. It just wasn't prescribed for this. This is one of those things. Healthcare is a weird place, man. Is this the most corrupt industry in the world,
dude? It's so weird. I got a letter over the weekend, last week, I guess, from my health insurance provider. The asthma inhaler that I've been taking for like 20 years is made by GlaxoSmithKline. It's going off the market. They're not making it anymore.
Albuterol?
They're just going to stop making it. Flovent.
Really?
Because I guess they lost exclusivity, the patent exclusivity. Now it's going to be generics out there.
It's not worth it.
They're just going to stop making the drug that I've been taking for every day for 20 years.
Here's what's going to happen.
I was like, what?
Well, they're not interested, right? Because they fell off the patent list. They're not going to make the same amount of money from it, so that's not the business they want to be in. These generics will pick it up, and they'll start making it, and you'll get the same thing from another company.
All right. Defense is most corrupt with healthcare close second. I'm with you, T-Money. Okay.
Defense is bad. I know some things about that. Yeah. All right.
Let's bring on Kimmy and different. Let's get a different perspective on today from the conversation we were having earlier. Let's
ask Kimmy about how she treats.
Hey, Kimmy.
Hey, guys. Hi. Oh, one guy.
One guy. JC is in a football hole of shame, I fear. But he'll be back tomorrow when he recovers. We were having a conversation earlier, Kimmy, just about coming in on a Monday morning when something big on the news front happens over the weekend, right? Good or bad. In this case, it's obviously bad. Very, very bad. And you're a trend, and you're much more short term than we are, right? So, how do you come in this morning when you come in? You see oil's going to be up, obviously. All the defense stocks are going to be up. How do you react as a trader to a big news event like this?
Well, listen, Friday was a big day, right? I mean, all the indices were up over 1%. The market went sky high. Well, not sky high, but started flying, right? And then, listen. This news is negative. So I will just say, when our government wants to dance with the devil, Iran, this is what you get. And don't worry, Israel will fight back tough.
Right. But I guess I'm referring, we don't have time to talk about that. But I guess I'm referring to as a trader.
As a trader, we're pulling in. We're back to. We broke above the SPY and the Qs, which are important. Broke above the 8-day moving averages. Okay, we plowed right through them. I did say in the room the Qs have potential up to 364. SPYs up to 430. We hit those levels. Now we're pulling back into the 8-day. So I'm going to use the 8-day as support, see if it holds and trends higher. Usually war is kind of bullish for the market. So we'll see what goes on.
But do you I don't know if you keep track of these things in your head. Do you get the sense that volatility based off, war events is it short lived, or is it are these? I've always thought these moves tend to be overreactions a little bit.
Yes, they
Have
are.
you observed?
They are.
Yeah.
It could be
Okay.
short-lived. I mean, we could trend back up
Yeah.
today, or maybe we trend a little sideways. I'm just going to see how we hold the moving averages today, see how we hang on. Oil is gapping up. Defense names are gapping up. Lockheed Martin, which I believe I traded on Friday.
You did?
Yeah. Unfortunately, I didn't stay with it. Who the heck knew that it was going to gap up, right? So
How could you have not known that, Kimmy? Come on.
I know, right? I couldn't predict war. So, listen, the market Friday was very dicey. The market we were heading lower, and then all of a sudden we ripped in names. So I took a loss on Thursday, ripped back up. I was like, I'm not sure if I trust it, and the thing friggin' went.
We haven't even. I've been so distracted by the events of the weekend. We didn't even really talk. I haven't even thought about really Friday was what a freaking reversal that was.
I know it looked like we were going to break the 200-day on the SPYs or the S&P, which we did not. And we held at support around 419.50 or so, and we just went from, and we went up. And listen, you can't predict that. You don't know how far the market's going to go intraday, and it just kept going on a Friday. And of course, Fridays you want to chill out, we made our money, this and that. I mean, there were so many things to be had. I mean, I told people in the room, watch Meta over 310 where it's been stuck, watch these names over here, and things went up, all over the place.
Okay, so crazy reversal on Friday and end up on a very, very positive note. Come in this morning on a pretty negative note. How do you balance those two things out?
Well, the indices are gapping a little. They're down, but it's not terrible. Like I said, we're back. We're above resistance, so now it becomes support. So I'm watching these support levels on the indices and see how they manage them today. I think they're okay. I think the market does have potential to hold on unless something,
Okay, so bullish until proven otherwise.
Right.
What? Give us some names on your radar this morning. I know it's late. I know you have to hop.
Yes. So Crowd, CRWD. Broke out, hit a new high. I'm going to watch that name, see how it handles today. Disney's gapping up. The Peltz family came in, and I think he's looking for a board seat. So I'm going to be watching Disney today. It's kind of been obviously dead money for a while, but we'll see how that goes today. I'm going to be watching oil names to see if they can hold on to their gains or not.
Yeah. All right. Kimmy's going to go to her trading room. She calls out trades every day in her room as she's making them. Kimmy.
Have a good one.
All right. If you want to join the room, check out the link in the description. It's right there at the very top where it says join Kimmy's live trading room. Okay. 9:24 here. We'll do like a market update after the open. How about that? Hey, you know what comes back this week? You guys are as excited as I am. We do actually have some earnings in the back half of the week. Friday is kind of the start of earnings season, so that's always fun. And before I forget, before we move off of oil for the day, someone had emailed in and asked us to react to this article about the oil patch being primed for all these mega deals after the ExxonMobil Pioneer deal from last week that was announced, or at least reported. I mean, there's been consolidation in this space for 100 years, and it took a bit of a breather. Last year, the M&A reached a 20-year low in oil and gas. It was just very little activity last year, and these companies are sitting on massive cash piles. Exxon's got $30 billion. Chevron has, I think, the same or similar. I mean, they have so much money to spend that and when you see one domino fall, it tends to cause a chain reaction. That's not unique to oil and gas. That's every industry. When you get one major deal, smaller deals tend to follow. So I would definitely keep an eye on energy for some more M&A because it tends to be a trend.
M&A will pick up in a huge way if this bull run continues. They just need more higher oil prices.
That's all they need.
Oil is similar to biotech in that way. right? Where these explorers pop up. They're not well capitalized, right? So they're exploring some piece of land, looking for, drilling for oil. And then the big boys have to come in and fund that in different ways, whether through partnerships, just capital injections, or just outright buying the companies. And oil companies in the U.S. have been afraid to grow, set up more rigs, add more supply to the market in any way, increase production, hire companies to set up new projects, acquire companies, right, to just grow the size of their operation. They're afraid to do that because of regulations, pricing. I think there's been a huge hesitancy. I would have thought M&A would have picked up in a big way, and it really hasn't. I'm still waiting for it, and I think it does come. But let's see. These guys have been burned before, right? Making huge investments into new projects, and then the government kind of screws them. So they're very timid to go out and acquire. But I think, you see oil prices back in the hundreds, they're going to have no choice. They'd be crazy not to. So we'll see.
Yeah. All right. Fonz, can you bring up slide number 5, please? I want to talk about this for a second. Mike Zaccardi tweeted this on Friday, and I got a really good kick out of this. Whoops, sorry. This is Goldman Sachs's sector allocation recommendations for the year. They published this at the start of this year.
They suck.
And just holy crap. This is why predicting stuff is really freaking hard, man.
Underweight all of the leaders. Underweight
what a disaster. What a disaster. Overweight staples. Energy, which had a good summer. It's not like it's had a great year.
This was for all of 2023, Spencer? This was released?
Yeah. Yes. This was the year-to-date sector allocation recommendations for the calendar year.
Disgusting.
It would have been hard to do worse, frankly. I mean, if they had utilities overweight, that would have been bad. But just awful. It just goes to show. I mean, we talk about it all the time. Just because you're at a big Wall Street bank doesn't make you all knowing. Doesn't mean you know more. No one really knows, right?
That's the way this is set up is terrible, right? Like, here's the difference between technical and fundamental analysis. We would never show you, as a technical shop, our research team would never put out, here were the sectors we thought you should have been in back in January, because it's fucking October, and that's changed, right? These guys have to go back and tell you, here's what we said at the beginning of the year, and here's what we think. Like, they have to stick to these terrible theses. When the facts come in and they want to change their opinions, they're stuck with, well, this is our 2023 outlook. That was us or any good technician. We'd rip it up, say, we have new data. This is the new sector outlook.
Yeah. It's hard because, this is how people get it. This is how advisors take this information, and it all trickles down. It all trickles down to their clients, right? So it's tough, man. It is
tough. They have difficult jobs, near impossible.
No doubt.
Speaking of
all right,
analysts, one more thing from the newspaper. I thought this was really interesting. I know we have a lot of young people who watch this show, reach out to us for advice. Those are the best emails, by the way.
What do you got?
Why no one's going into accounting? Did you see this one?
Oh, I read that.
A lot of University of Maryland shout outs.
Yeah.
I wanted to just focus on this one piece here. Basically, the article was about how accounting jobs, not only are people less interested in them, right? So less students are going into accounting and looking for accounting jobs, but just the wages have really stagnated there. And this is something that's pretty close to home for me. I was an accounting major, worked in the Big Four earlier in my career. And it was really this sentence here. The current shortage of accounting recruits marks a sharp turnaround from 15 years ago. Accounting's appeal grew after the 2008 financial crisis because of its stability. And it goes in the University of Maryland's accounting department, granted nearly 100 more undergrad degrees in 2012 than it did in 2008. So what it's saying there is there was an explosion in accounting during the financial crisis. And there really was. I lived through it. I was a finance major at first at UConn. Perfect grades, top of my class. 2008, I was a junior looking for an internship. There were none. There were just no finance jobs. Went to my counselor. I said, I can't get a job because nobody can. Doesn't matter how, who you are. So I said, I got to switch that. And everybody said, just go into accounting, you get a job, you're safe there, good pay, blah, 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 blah. And they were totally right, but it's like a staple stock, accounting.
Yeah, it is.
So you might not lose your job in a bear market or a recession. Your wage will be a lot better than your buddies or investment bankers or lawyers. But in good times, in a bull market, they're going to see 2-3x growth in their wage, and you're just kind of going to hang out because you're the defensive play, right? And we talk about this all the time. If they're going to cap the downside for something, typically the upside's capped too. And I think that's just what's going on here. Accounting is having that recession-proof moment where maybe the market's good, the job market's great, and they're not gaining as much as other places. And I guess the point is we've seen this a million times, and that's just the nature of the profession. So the benefits of it also lead to certain, disadvantages of it. But that's, I thought it was an interesting take.
Yeah. Well, what's the stereotype about accountants is that they like to play it safe anyway, right? Like, they're boring people who play it safe. A stereotype. Yeah, I mean it is that kind of a job, kind of a career. It's also not the easiest job in the world, so kind of interesting to see. You can understand why people would not want to do it when wages aren't going up and the job itself is not the easiest.
Here's the advice I would give is this: you love accounting, like you're passionate about accounting, and some people do. I enjoyed it for a good amount of time.
Yeah.
Then go into accounting, but don't do it because it's the safe play, right? Don't do it for that reason. Do it because you enjoy it and you're passionate about it. Some people really love accounting. Go. That's for you. If your passion is in markets and being an analyst, don't just say, okay, I'll do accounting because it's safer. Go for it.
Yeah. Okay. What is this article? I did not read this. You dropped this in the doc about Texas cities are booming, but their offices are mostly vacant.
Hey, somebody did a lot of reading this weekend, huh?
Oh, actually, before we get to that, can I just say how happy it makes me that you get a physical newspaper delivered to your house.
There was so much good stuff, and I have WSJ online, but there was so much good stuff in it. I was at the CVS. I was already kind of halfway through some of these articles online. Don't you just like reading a paper more than a screen? That's all it was. I don't know.
Yeah, I don't get a newspaper delivered to me, and I never will. But it makes me happy that you have one. So
when I saw Oprah and an Ozempic story on one of the covers, done.
Yeah,
getting this.
Done. All right. Anyway, so wait, what did this article say? I didn't read it.
I'm gonna do this. I'm gonna bring every spooky commercial real estate story. I'm just gonna talk about because I can't say enough how nasty this narrative is right now. And we've talked about it on here before. Like I'm always thinking about what are the risks? What are the unknown risks? Right? This isn't one of them because everybody and their mother already knows about it. Real estate is a problem, particularly commercial real estate, particularly in big metropolitan areas. Been a problem, right? So we're going to see more and more of this spooky stuff. Hey, real estate stocks are at like historic lows on an absolute and relative basis. So they're pricing in a lot of bad.
I get a lot of my sentiment, my like retail trader sentiment from Reddit, from like the Reddit stock subreddits. And like, I see a lot, not a lot, some people, most people just can't help but buying the dip, right? I'm seeing a lot of posts about REITs right now. Like, oh yeah, I'm getting it at a huge discount right now. Oh, I just pulled the trigger on a big purchase in last week. Like, why? I understand the need, the psychological need you get, the psychological break of thinking that you bought something for cheap, but understand why it's cheap, I mean, it's cheap for a reason. I don't know. I don't get it.
What else do you want to talk about, Spence?
Christopher Brown still gets his Barons delivered every week to the crib. Christopher Brown, I tried going to barons.com last week and the site wouldn't even open for me. I don't know if I'm having a boomer issue. I don't know. I couldn't even get on. Whatever. Anyway, do we have anything good in hot corner today? No, nothing good in hot corner. That's a shame. Okay.
I want to talk about the price action last week, though. I have some really, really important stuff to talk about right now.
And would you say it's in Strazza's spotlight?
Yeah.
All right.
Yeah. All right. So I see we got the gold charts ready. This is what I really want, though. All right. Slide 5 and 6 here. So let's just start with 6 for some context. Tops. Are these tops? Are these valid reversals? Or are buyers going to step in, repair this damage, and these are some bull hooks, and it's go time, right? Next chart. S&P. Right. This is what we were looking about. This is what we were talking about last time.
What a Friday candle. Oh, man.
And that's exactly what we're going to talk about right now. I'm a big candle guy. Pat always tells me, you used to be a bigger candle guy. No, I just tweeted about it more. All over these candles. October 13th of last year, there was an absolutely epic candle in the S&P 500. You remember that, Spencer? We have a picture of that candle, Fonz? I got to get it. So let's go back, show you guys exactly what we're talking about here. Throw this up. Okay. October 13th, last year, CPI came in hot. Everybody said, man, if CPI comes in hot, market's going to tank. Came in hot. Market tanked, ripped, reversed higher. We had these epic bullish reversals. Some of them were Maribozus. If you look at S&P futures like we have here, see that candle? It stands out at the bottom of the screen there. It's that long lower shadow, massive real body. And there were a lot of even better ones out there, right? If you don't look at the futures, if you look at the indexes themselves, massive bullish engulfings. And that was really it. That was the bottom. We took off from there. Throw up the cyber chart now. Okay. What is a bullish engulfing candle? Bullish engulfing candle is when the real range, and the real range or real body range of a candle means the difference between the open and the close. Right? Not the high and the low, but the open and the close. That's the candlestick body, right? And if that is covered by the next day's candlestick, and it's green, that's a bullish engulfing. If that real range is covered by the next day candlestick and it's red and closes down below the last open or close, then that's a bearish engulfing. And what it's telling you is that buyers and sellers explored one side, right, by making new lows or taking out the range lows of the day before, and then decided, nope, never mind, we're going to reverse it. And then they close in the opposite direction, right? They engulf that whole range. Does that make sense?
Yeah.
It's telling you who's in control for that day based on the prior day. And they're pretty rare candles to engulf one day of price action.
Wait, what was the day we had the big bearish engulfing candle? I don't remember what it was even in though. Do you remember that? It was like a month ago or 2 months ago.
I don't know.
Okay, never
mind.
We've
had some nasty engulfings, bearish engulfings since the summer.
Yeah. Anyway, continue.
So, if you engulf just one day of price action or a real body of a candle, that's an engulfing. In case of the NASDAQ Cybersecurity Index, and this is the case for internet software, I could show you so many examples. This is the most extreme. That's why we went with it. Spencer, it engulfed 11 days, more than 2 weeks of price action in one candle. 2 full weeks. It explored the lower bounds of that range and then ripped higher and closed at new 2-week highs. So look at this chart right here. It really explains it. We're looking all the way back to just the pivot highs here from late August. And then you have the little downtrend. We come in, we kind of start chopping in this tight little range. And this was a monster resolution. And we're seeing similar candles to this across the board in tech and growth indexes Friday of last week. One candle doesn't really mean anything on its own. Now we need to see follow through. And I think you're going to get that today. I think you're going to see some big red to green today and follow through on these massive sticks from Friday. And I can't tell you how super bullish that would be for the short term. I've been on here since last week talking about, man, if this is a failed top, oh my God, you get that little shake. We're going to go. This could be an explosive move. What I didn't know is that the move might even be kicked off by some of the most epic bullish engulfing candles I've ever seen in my career, right? So this just makes me even more bulled up that, okay, these are little scoop lows and we're going to get a bull hook higher, at least in the techiest, growthiest indexes. Friday's candles were so bullish. We need that follow through today. If we get it, look out. I think Mark alluded to those highs from July coming back into play. in the S&P. I think it's 4,600. That's where we go. We get that follow through today. We're on our way. It's go time.
Also, what do you see when it, how does it react today, especially considering it opened down, right? So you can see it, Cyber's already green on the day.
I love that they opened down.
Right. So it opened down. We knew that would happen, but if it can close green, that gives you even more confidence, right? So,
like I said, if we go red to green in some of these tech and growth indexes today that had the monster moves Friday, again, look out, get long. This is going to be just some monster trading opportunity. This thing probably runs for a couple weeks. We do go back to those highs, whether it's tech, NASDAQ, S&P 4,600. That's where we're headed. There's going to be some great trades. It's tech. You want to be in tech. You want to be in growth. You want to be in cyber, internet. Do we have the internet? Throw this one up. There were so many good charts. Maybe we'll do more on this tomorrow. So here's Dow Jones Internet. It's monster base.
And then we'll have Sean. We'll bring Sean on in a minute as well. And
Sean loves this price action. Throw this one up. So Dow Jones Internet's like so clean. I was tweeting about it last week. I was talking about it on here. Like, this is Google, Amazon, Meta, some of the best stocks. This absolutely has to hold. Look where you get this bullish engulfing. And like even Internet 1, 2, 3, 4, 5, 6, 7, 8, 9. I think that engulfed about 11 days too. If I were to zoom in, same thing. But look where it's happening, right? Right at those old August highs, the Q1 highs. Couple touches. Oh, is this a top? No, the bull engulfing comes right there. This is a launch pad. This is just a huge launch pad for these stocks. And a lot of people think about this too, Spencer.
This looks so good.
Dude, you got to be long.
That it's making me want to buy it right now. That's how good this looks.
And think about a money manager or any of these institutions that maybe weren't long tech and missed this all year. Window dressing. Chasing performance.
It's a little early. It's a little early for that.
No, chase them into the fourth quarter. Hell yeah.
All right.
You can send out statements to everybody for Christmas. Hey, look what we own. We've been in Google, Amazon. Look at us.
That's true.
That's what's coming. I think people are going to chase these things hard into year end.
Damn.
I want to be involved. You should too.
Stop it. You're making me too bullish. All right. Let's see what Sean thinks.
Let's do it.
What up, Sean?
What is happening, Spencer Spence?
Are you agreeing with this general sentiment? Bullish tech?
I don't have any feel on window dressing, but I like it. I mean, my portfolio is positioned for that, so let's do it.
Okay, good. All right. Put your money where your mouth is.
Ken K.
Where our mouth is.
Ken K. Bullish engulfings only for reversals, not trading ranges. That's not true. They would mean less in uptrends, more in a real downtrend. First of all, these were downtrends into ranges. And even a sideways market, bullish engulfing means something.
Well, Strazza, I'm liking what you're laying down here. My portfolio across all my portfolios that I manage are all leaning a little bit long. So I'd love to see some follow through. And it looks like right now, I mean, it's early, but the market seems to be agreeing with you.
I mean, Friday was such a big day. Last week, we talked about how I felt a little bit unsure. Often when you're feeling unsure going into a trade, it might be uncomfortable, but a lot of times it ends up being the right thing. And I was saying to you, boy, these premiums are juiced. I want to get long calls. I think there's going to be an explosive move. Sometimes the market is just so damn good. They were juiced for a reason. These growth stocks, these tech stocks, high premiums for those calls, those short-dated calls. Boy, if you got that move Friday, they already paid you. So,
well, I mean, look.
I think today is important. We do need to turn green in some of these indexes. Got to see that follow through. And then I think what Mark was saying today too, if the worst groups can just stop falling, look out. Check out those micro caps. They're hooking higher.
Well, look, we as a general rule at our shop, we like to follow trends. We are trend followers.
Oh yeah.
I think we all agree with that. But I think we also all agree that when markets get stretched, they're like a rubber band, right? And mean reversion is a real thing. And yeah, Friday's trade certainly felt like the rubber band snapping back to me after a tough, let's call it 4 weeks in the S&P, or if you want to even go back to July. We were due for a day like that. I'm surprised it took that long, to be honest.
Facebook positive today. Yeah. Listen, even utilities getting themselves up off the floor here today. Energy's up 3%.
Ooh, I could use some relief in those utilities.
What's your war trade, Sean?
My war trade is to turn off the TV.
Thank you.
Oh.
That was my recess, man.
Listen to this man.
Turn off the TV and get off Twitter and go outside. That's my war trade.
All right. What else is on your mind, Sean?
I hate coming on here and being a broken record, and I know that we, Friday's trading action, if we see follow through today, can be a clue to a major change in character. But I'm still in the camp of guilty until proven innocent that we are in sideways tape for extended period. I think it's going to take. We're going to have to wait till earnings season kicks off to really get a new direction declared in this market. And so until then, this boring options trader over here just continues looking for opportunities to sell premium if I can find them. They're getting harder to find because of earnings, but that's my MO. In fact, if I can't find any, then I'd rather just sit in cash and do nothing. That's where I'm at.
Listen, I think you make a good point. It's still really messy out here, especially for most things, right? We could point to the communications, the tech, NASDAQ stuff that's looking higher. Even the index hasn't really undone the top like the S&P 500, right? I worry, like you just said, about earnings being right around the corner, because something that we see all the time as technicians and people pay attention to earnings is weakness into a report or weakness into an earnings season tends to foreshadow a bearish reaction to said report. And that's exactly what's happening with the financials and the banks right now. Banks are going to kick it off.
They will find an excuse. It doesn't matter what. They will find a reason. Oh, net interest margin was 0.1% below estimates. Oh, got to sell. Have to sell.
They're down 15% since the July peak. I think the question is that enough, right? Because I think these banks, this is going to be a disaster quarter for them. So is the market ready for that? I don't know. Maybe we'll see. A lot of times it's a disaster quarter be the bottom, right? The market says, that's a disaster. That's it. Okay, let's go.
I know we're not fundamentalists here, but so you're saying that the banks are having trouble making money in this high interest rate environment? That's surprising to me.
It's against, I guess, contemporary wisdom. Higher rates traditionally good for the banks. Really the spreads, though. And the yield curve is all messed up for them. This is not a money-making environment for the banks. In fact, I think, and we've had a couple of smart guests come on and kind of allude to the same thing, the banks are in the worst position for rising rates. No group of stocks will be impacted more negatively than the banks, for sure.
I mean, read between the lines. You got Jamie Dimon saying the world is not ready for 7% rates. You mean your bank is not ready for 7% banks? 7% rates.
It's a good point. Yeah. I think the world is ready, and the world will be fine.
Yeah,
banks are going to really struggle. So we'll see.
Strazza, I was this weekend, kind of a throwback. I was, having a crypto weekend. Not really. I wasn't really trading, but I logged into my Coinbase account because it's been a little dormant for the last couple of months.
Nice.
And maybe I'm the last guy to the party here, but I happen to notice that the USDC coin paying 5% interest on Coinbase. I mean, that's pretty good, right?
Okay.
Should I be worried about that?
Can they still do that?
Are you collecting that on Bitcoin?
Well, I mean, I have a little. Most of my Coinbase assets are invested in Bitcoin, Ethereum, Solana, like the big ones, right? But I do have a little bit of cash that was just sitting in cash, and I saw the USDC paying 5%. I'm like, oh, maybe I should move that into the USDC. It's not a lot, but I was like, and then I was thinking, is this safe? And should I move my checking account cash into this? I mean, that's pretty good.
Why don't you have
I'm with you, Spencer. No.
Well, why? Okay. No, but this is great. I love this. All right. Thought experiment. So you're in the USDC. Ideally, that is just crypto cash. There's going to be no price appreciation or depreciation. You get 5%, call it a day. I guess what my first question to you would be, do you not have a checking account? for a high yield savings account that can get you that 4 or 5%? Because there's plenty out there.
Five
have a
is
checking account.
tough. 5 is a little high.
4.5 Fidelity.
Yeah, 4.5 is doable. 5 is a little high.
Would you take 4.5 at a real bank rather than 5 in USDC on Coinbase? I guess we don't.
Yeah.
Yes, I would, but I don't think my bank is paying me 4.5. I'd
Get
have to
rid of
look.
them.
You should
See, look, I'm the kind of customer that banks love.
Yeah,
I've had a checking account with Charles Schwab for like 20 years, and I'm not changing.
Me too, but I love Schwab. What are they offering?
I don't even know.
Getting that high yield
checking accounts are not high yield accounts anyway. It's all about the
they
same.
have a high yield checking like sweep thing. Hold on, let me see.
Really, I thought Schwab was known for screwing over the customers in that regard. They had the lowest rate sweeps of anyone.
Well, I know that Schwab like really, really, really wants you to trade with your money.
Three Schwab Bank. Oh no, this is old. I don't know.
There was a thing a year or two ago. Schwab had like the lowest yielding sweep accounts that they defaulted all their customers to. Yeah. Anyway, Sean, at your inspiration, I just logged into my Coinbase account for the first time in a while. Bitcoin, Ethereum, Solana, not looking great for me. Oh well, not looking terrible, but not looking great.
Yeah.
Anyway, Sean, question for you. So, some of the big banks reported this week on Friday. So, does that mean for you, like starting next week, you be like a little bit more keen to look at an options trade in the banks once? Like, do you look as soon as the earnings are passed, or do you have to wait for it to shake out?
Well, earnings coming and going is not a trigger at all for me to put a trade on.
Well,
the first trigger is, do I like the setup? I go the other way. Do I like the setup? Yes. Okay. Great. That's step one. Step two, is there earnings coming up? No. Okay, great. Proceed. If earnings are coming up, then usually it's a pass.
Right. Okay. That's fair. But the earnings come with volatility that would muck with the options a little bit. So
yeah, I mean, look, there's a whole cottage industry of traders out there who all they want to do is trade options around earnings events, and they generally want to be sellers of premium. And I've got nothing wrong with that. That is a very effective strategy for people who are very smart about position sizing and picking their spots. That's not my strong suit. I don't feel like I have an edge there, so it's not a game I like to play. But I know several people who all they do is trade earnings, and they put on like short strangles, the day before earnings and cover it the next morning. They're in the trade for literally 1 hour of market time, right? And they do very well with that. They occasionally get burned, but overall they do it enough that the edges play out in their favor. But they're not just blindly selling straddles or strangles on every earnings event. They have their reasons for why they like certain stocks at certain times. But that's not a game where I have an edge, so I don't play it.
Tough game to play. I don't think anybody has an edge in that. They might think they do.
Well, the edge they have is that options premiums are generally overpriced. That's the edge. Now, how they trade that edge is a different story.
How about the people who are buying calls into earnings?
I mean, those people. The edge that they think that they have is that they know something the market doesn't know.
No, it's just they like to gamble.
And they like to gamble. And the options market will gladly take their money every time.
Yes, they will. No, Steve made a very good point, though, about earnings reactions tend to resolve the underlying trend from before earnings season. So, like, stock sectors and uptrends tend to rise through earnings season, and those in down trends tend to fall through earnings season. So, keep that in mind, because they will always try to justify it with the move with the report, but just keep in mind what the move was prior.
So I know you mentioned it earlier, Spencer, but remind me, does the bank's earnings kick off end of this week, or is it next week?
Yes, it's this week. Thursday, we got BlackRock. Friday is JP Morgan, Citi, Wells Fargo, PNC. So yeah, the banks are kind of actually, I think we have Pepsi tomorrow, but banks are the unofficial start.
Things are going to start getting interesting here. I like it.
Yep. Delta on Thursday, Domino's for some reason on Thursday. Didn't realize that. So yeah, banks.
Domino's up. Wow, that's some weird candle in Domino's today. SoFi is at the top of all these lists. I know you love SoFi. That's your bank.
I'm wearing a SoFi T-shirt right now. Look at that.
I am a customer. I'm not a shareholder, but I am a customer.
Are you collecting that 4.5% interest?
Yeah, for sure. Of course I am.
Sick. So it's these. We've talked about this before, but it's these new age finance companies that are able to pay the high rates now. It's not your old school banks that are able to pay the big rates. Right?
Because there overhead.
There are a number of banks. There are a number of banks that offer 5%. I've never heard of them. Like when I see the list of, I've never heard of these companies before. SoFi, I've at least heard of them, right? You know what I mean? Like, yeah, they may not be Bank of America or anything like that or Wells Fargo, but like they've been around for a little while.
They got their name on a sweet stadium.
Well,
cool stadium.
Yeah. Okay. But sure.
These are FTX though, so I mean we could leave that one alone.
Yeah, these companies all came out, they IPO'd, they raised a bunch of capital, and then they bought sponsorship rights to all these stadiums. Some of them still have them, some of them don't.
Yeah. Crypto.com.
Hey, you see Coinbase all over the place. If you watch an NBA game, see the Coinbase is everywhere. It's on the
poll. Well, they're the only ones left standing. So
for good reason. Also, I just want to shout out, they don't pay me. Public is the way to buy treasuries, man. Boy, do they make it easy.
Speaking of buying treasuries, let me just say, I've said this before. Do not buy treasuries via Treasury Direct. Trust me. Okay, it will be the worst experience of your life. Go into the open market, buy it through a brokerage, buy an ETF, whatever you want to do. Don't go buy government bonds from the government.
I didn't peg either of you guys for treasury buyers. Listen,
just don't buy government bonds from the government. You're welcome.
You guys spending your weekends playing shuffleboard in Boca Raton? What's going on?
What do you mean?
Don't knock shuffleboard.
Why not, Spencer?
Because trying to do any sort of transfer or anything is a total.
Did you hear what I just said? Go to public.
Yeah, I'm agreeing with you.
You're still buying treasuries from the government. Who do you think you buy treasuries from?
No. I mean, but treasurydirect.gov. Like, don't go through the government's website. Go through a broker or something, or brokerage platform like public. Don't do it from the government's website, right? Directly.
Yeah, I would. Yeah, fine. It's terrible. What I will say, there are some bond funds out here that are just paying you like ridiculous sums. Like I just looked up the EM high yield, 7.5%.
Nice.
These fallen angel funds, 5.5%, right? That would be like the US high yield stuff. And if you're feeling crazy and you really, really want a yield, give me my blessing. It's the midstream operators in the oil and gas industry, and bought my first LP in like 12 years.
All right.
Last week. ARLP. If you want to chase a fat yield, 12.5%. in this battle. And they're doing coal things, and the price of coal keeps rising, and business is good.
Right.
So I think you're actually going to get that super ridiculously high dividend from them. I will report back, though. And I will also report back and complain about the K1.
Yes, you will. Do we have any recess or nah? I kind of did mine already.
Real quick. I got a quick.
Okay.
First of all, fine. Yes, we have to mention it. The Miami Hurricanes, what a debacle. Saturday night.
What was that?
I've never seen that before.
I'm sitting there watching with Rose, and I have to explain. She's just getting into football, so I have to explain stuff, right? So I'm yelling at the TV saying, "Why are they running on third down?" And I pause it. And she's like, "Well, why? What's wrong with running?" And so I explained. I said, "Listen, well, theoretically, this is dumb because he could fumble. I know there's only 20 seconds. They could pick it up, and then they could come down and score. So that will never happen." Unpause. Guy fumbles, and the rest is history. I talked to my dad. He's like, "I thought they won. I changed the channel. They didn't kneel." So here's what happens in that situation. The guy who fumbled is going to feel like crap, like it's his fault. The secondary for allowing that touchdown pass, they're going to feel like crap, like it's their fault. But it's really just the coach's fault. And that was pathetic. So, big bummer.
That's pretty amazing that you had that experience where you paused the TV and explained why this is a bad idea, and then it happened. That's the best part of the story.
I thought I was being punked.
There was a college football reporter that went back and realized that the coach of Miami has not kneeled all season. Like, they don't call kneels. What is going on over there?
Oh, okay. So that makes sense then, because I was wondering, like, were they trying to pad that running back
they
stats?
Don't
like, what was going on there?
They don't do it.
That's bad form. He's got to figure that out. They love him in Miami. Boy, that might change.
They don't do it. Anyway.
All right. Well, my recess is, I got two quick things. First of all, how great is it that Strazza had the easiest travel schedule this weekend? Whenever Strazza travels anywhere, he usually has the shittiest travel schedule because getting in and out of the Keys is terrible. But he went to Miami this weekend, and it's JC that's caught in travel hell and not Strazza. So that's good.
Yep.
Secondly, speaking of travel, I might not be here next Monday, boys, because me and the family are doing an impromptu little road trip down to Santa Fe this weekend coming up.
Oh.
And we may stay through Monday. The only reason we may be back is because my wife might have to do jury duty on Monday. But we won't find out until Friday.
You're driving there, Sean?
Yeah, we're driving there. It's about a 7-hour drive from where I live.
It's not so bad.
So
if anyone has any Santa Fe recommendations, I will gladly take them, because neither of us, my wife or I, have ever been to Santa Fe. We have no idea what we're in for, but we just thought it'd be a fun little place to go check out.
I got nothing for you. Sounds fun though.
I got nothing.
Spencer, speaking of jury duty, Sean just mentioned it. We watched. It's
And
only 6 or 7 episodes. Spencer mentioned that new show, Jury Duty, on Amazon Prime.
Yeah, what do you think?
You're absolutely right, dude. It was great. We both enjoyed it so much.
That's what I've seen all year, man.
Yeah, that was excellent. Everybody go watch. It's only like 6 or 7 episodes, like a half hour.
Yeah, it's awesome.
That over the weekend.
It's awesome, man.
Now I want to see a new season where they don't have like the best guy in the world. Now, like get a real human and put him through those situations and see the way. Because this guy, I don't know if they knew that going in and that was the idea, but what a saint.
You restored my faith in humanity.
What a saint. Now get like, not a scumbag, but like somebody who's going to react a little bit more.
One guy. Anyway.
He was in situations where he was just like cool with things and being so nice. I'm like, what the hell is going on? I'd be losing my mind.
My wife and I watched the trailer to that this weekend, so we're looking forward to watching it.
Oh, it's wonderful.
We got to finish the last season of Best Call Saul first.
Yeah, you better get on that. All right. Hey, that's our show for the day. These guys, Sean and Strazza, will be back in an hour and a half, give or take, 11:30 a.m. Eastern time for the Flow Show. Watch as they come up with an options trade on the fly. It'll be fun. You should be there. Thanks to our guest today, Mark Newton. Thanks to Sean. Thanks to Kimmy. Thanks to all of you in our chat. JC is back tomorrow, provided he can, get home and all that. So that's it. Hey, drop us a like. Follow us on Twitter. Follow us on, subscribe on YouTube. Do all that good stuff. We're on the Instagram. We're on the YouTube. We're on the Twitter. Look at all those places we are. Come check us out there. Everyone, catch you guys later. Go make some money.
Happy Monday, everybody.
See ya.
I can't take no loss. I don't even know what it costs.